Welcome to FounderLine. I'm your host, Joe Beninato. Thanks for joining us today. It's great to have you all with us. Our goal with FounderLine is to help people who are involved with startups get their questions answered. So whether you're a startup founder and you have an issue you want to talk about, or you're thinking about joining a startup, you've received an offer and you'd like to find out more about stock or cash or whatever it might be, maybe you're thinking about starting a company. Any of those situations, you can contact us, call us, tweet, email, and we're going to try and help you out and answer your questions. This is a live show, and so we're bound to make a few mistakes, but we want to hear from you. We want to interact with you. Call us now, toll free, at 1-844-4FOUNDER. Don't dial the last R. We've heard some people issues with that. That's 844-436-8633. You can email us, help@founderline.com, or you can tweet to @founderline. If you want to ask a question anonymously, you can go to our website and you can submit a question on one of the pages there. So with that, let's get started. Our guest today is Greg Sands, who's the founder and managing director of Costanoa Venture Capital, a relatively new venture capital fund. Greg's worked with some of the iconic internet companies, including Cisco and Netscape. He's been an investor first at Sutter Hill and now at his own firm, Costanoa, in companies like FeedBurner, Merced Systems, Guardian Analytics, and Quinn Street. Greg, welcome, and thanks for joining us on FounderLine.
Thank you. It's great to be here.
So before we dive into questions, I usually like to spend a few minutes just getting to know everybody and talking a little bit. And it was recently the 20th anniversary of Netscape, one of the iconic internet company, of course. And I mean, it's hard to believe it was actually that long ago. It makes me feel very old. I don't know about you, but maybe tell us what it was like in those very early days. The internet was just beginning, right? The first web browser comes out, Mosaic, at that time, and then Netscape gets started. What was it like in those early days back when things were just getting going?
Well, it was incredible. It was heady. It was totally chaotic. I mean, I'd been at Stanford Business School through the summer of through June of 1994.
Yeah. The
summer before, I'd spent at Cisco. An SE there, Jim Grubb, showed me Mosaic and the CIA website, which was one of the few things that was online at the time. And there were about 3 of us that went into something that looked like the internet industry, coming, right at the, effectively the birth of the commercial internet.
Yeah.
And I had my first interview with Jim Clark at his house before the company was incorporated. And it was, by the time I showed up for work, we were on the cover of Time magazine this was the cover of Fortune magazine as the coolest company in the of the year.
And the company hadn't even really started yet.
The company was 6 weeks old. We were 4 months away from shipping our first beta product, but it was it was incredibly intense. It was a little bit, we'd flip between being incredibly excited and having these moments of fearing for our fate. And we also did a bunch of invention. I mean, in addition to that core engineering team basically rewriting the browser from scratch, not a single line of used code, of course, from the open source Mosaic project. But we effectively invented the public beta.
That's right.
We invented, in some ways, free for personal use, but paid for commercial use. And so things just happened at an incredible high intensity, but it was really chaotic. And Jim Barksdale came in 6 months later, and a bit of calm descended. And then at that point, we started executing in a very crisp, directed path. But 8 months after that, we were public.
Crazy. Yeah. And I still remember I was working in the packaged multimedia CD-ROM world at that point, and one of our products was the first hybrid CD-ROM, which was CD-ROM multimedia content along with a connection to this thing called the web and more content.
Yeah.
And we could update it on a regular basis. And one of the packages I remember doing as a product manager there was, includes Netscape Navigator. It was like the first time web browsers were shipping out commercially, and just a very different world from today where you can go out and produce a piece of software and have it on millions of phones, very quickly. We're still, the plumbing was still being, put into the houses as we were going.
Well, distribution ends up being a huge problem.
Yeah.
Right. But then distribution also required a dialer, right?
That's
to
right.
get online.
That's right.
That was
an
its own
ISP,
complexity.
back when that
That's
met.
right.
Yeah, those were crazy
But
days.
to me, one of the really interesting things about it is that if I think about the 6 months leading up to the founding of Netscape, all of the heat in the venture capital and entrepreneurship industry was on multimedia. I mean, I remember John Doerr standing up and saying, who was he was the Series B lead. Jim Clark led the Series A himself. But saying the PC industry has been the largest legal creation of wealth in the history of the world.
Yeah.
And the multimedia industry is going to be even bigger.
and well, he was sort of right? I guess if you consider the internet multimedia. So yeah, it's amazing how far we've come. And,
That's right.
And getting to live through those waves is kind of an amazing. Like I think myself as being lucky every day because we get to see this stuff. The birth of the internet, the birth of the iPhone and the modern smartphone. After a bunch of great products from Palm and others. So. Pretty fun stuff. So you did that. I mean, amazing experience getting to go through an IPO like that, and then at some point made the transition into venture capital with Sutter Hill. Yeah. So how did that come about? Were there people you knew already, or somebody called you up one day and said, "Hey, we're looking for somebody," or how's that happen?
Yeah, it's a little random, but it does matter, I think, to have relationships. So I had met a couple of the partners through mutual friends. Okay. There was a classmate of mine who was working there and was planning to leave to go back east and be where he wanted to live, and I think had said, well, here are a handful of people you should call as my potential replacement.
Oh.
And so that's how I think the call came in. But I do think it was the case that I had connective tissue with a couple of the partners, close mutual friends, that just made it much easier for everyone to find that comfort. And it was about 4 years into my time at Netscape. I'd basically, other than my honeymoon, I'd taken 1 week of vacation in 4 years. We just had our first kid. It was a bit of a time to take a deep breath and figure out that next transition.
So did that for a number of years. What?
I was there for 13 years.
13 years.
Yeah.
So long time, and then got the entrepreneurial bug to go start your own firm, right? So talk a little bit about that. How'd you make that decision, and where are we now? We're about a year in, year and a half.
We're really 2.5 years in.
Oh, so even longer.
No, it's so I think there are a couple of things that are worth noting. I did feel like I spotted an opportunity, and that that entrepreneurial itch that says my highest and best use is to go take advantage of that. And in particular, you can look at the trends and say it clearly, unequivocally costs less money than ever before to build initial product and get into market and start trying to find product market fit.
Okay.
And yet, generally speaking, the response of the big multi-stage firms is to get bigger rather than smaller. And there's a bit of a mismatch there that's opened up. Many of them have increased their focus on later stage investing and growth investments and the like. And in the second half of 2011, it felt like there had been the creation of some new firms, but mainly with a consumer focus. And so I'm a software as a service, business-facing software, enterprise technology, high-value SMB services investor. That's what I do. And it just felt like that kind of firm hadn't yet been created in our category. And so if you have some entrepreneurial instincts, what could be better than getting to start and build your own venture capital firm? Pretty much nothing. Yep. And so I had a great experience at Sutter Hill. Continue to have great relationships with the folks there. They were supportive of my, going off to launch this adventure, and it's been great. So in terms of timeline, really started working on it full time January of 2012. first close was June of 2012. So effectively 2 years into actually having a capital base to work with.
That's fantastic, and we're lucky enough to have gotten to work together a little bit recently on a forthcoming company that shall remain nameless.
Yeah.
Hopefully they're watching right now and cheering us on. But no, but that's really exciting. There's nothing like starting your own company and feeling just every day. It's up to you, right?
That's
That's
right.
And as the team grows, that's a great thing to have happen. So. Well, great. Well, we're gonna dive into some questions now, and once again, we want to hear from you. Call us at 1-844-4FOUNDER. Email us at help@founderline.com or tweet to @founderline. So let's start off. Why don't we start off with a call? We have Ron who has a question about paying customers, and so. Let's see if we can get Ron on the line here. Hi, Ron. How are you?
Hey, guys. Thanks for taking my call.
No problem.
Yeah, I have a question about whether as a VC or really anyone that's evaluating a company and say this company has a SaaS product, whether you find it more valuable to have a lot of users, but they're sort of on the free tier or the non-paying tier, or whether you think it'd be more valuable to have a smaller user base, but they're all loyal paying subscribers. Basically, which do you think has more value? The potential revenue generation of having a lot of users, or actually currently having users that pay for the product and love the product?
Absolutely. Yeah, it's a great question. And I'll start out with a disclaimer, which is the most important thing is that your overall product and customer and pricing model and business system is completely aligned and that those pieces work together. And it's very possible to build either kind of business. I would say, generally speaking, in the venture community right now, if you have a product which has a great freemium application and has very clear things that you can do to create a premium product, and ideally have demonstrated conversion metrics into the paid product, that's a spectacular business. And those are the ones that often have the most explosive potential, but they're really, really hard to build. And so, yes, if you can build Evernote, go build Evernote. If you can build LinkedIn, great, go build LinkedIn. I think in the case of Evernote, it was pretty clear there were a set of premium features that are basically just their own product features. I think in the case of LinkedIn, they basically spent years building this crowdsourced database of proprietary data, the business social graph, in a way that you couldn't do with a paid product. You just couldn't do it. Now, I'll also say that most of the people, I think the majority of companies who launch a freemium product that's a SaaS product for business users and then go try to convert users to paid, find that those conversion rates aren't what they thought they were going to be. And it's actually quite hard to get people into the paid tier. And so we have an investment in our portfolio called Stitch Labs, which is an inventory and order management for small multi-channel retailers that was launched as a freemium product. And when I met it the first time, the conversion rates were just tiny. And revenue, they had a little bit of revenue, but almost it rounded down to zero and it wasn't growing very quickly. And at some point, the founder himself, Brandon Levy, said, everybody's got to pay. And there going to be a 30-day free trial, but everybody's got to pay. The entry price point is $50 a month. For someone in this category, really not very much. And revenue just started growing. And so there, I think it was clearly the right thing to just make it a paid product. It had enough value that almost everybody was willing to pay. They were just never forced to pay. So either one is fine, but the freemium ones are hard to do successfully, but have more explosive potential.
But see, I remember going through this at Tello even recently, and that's such a hard, everyone says freemium is the way to go, right? You hook people in, and then of course they're going to pay you some money. So that decision, I forget the guy's name, Brandon.
Brandon at Stitch Labs.
To say, all right, everybody's going to pay. I mean, to some extent, if they're not giving you money, they don't love you, the customers, that is, right? So getting them, like how do you make that decision? I'm sure there are a lot of people out there who are going through these sorts of questions as they're building their businesses and thinking about business model. Like, should they go freemium typically, or do you say start charging from the outset and see what happens?
Well, I think so. The easiest example is something like LinkedIn, where you say, when there are even 10,000 users, it's just not valuable enough to charge.
Right.
And once you have that social graph built, there are a discrete set of applications initially around recruiters for whom it's incredibly valuable, and frankly, I find it valuable enough to be a paid user, and I'm sure many of us do.
Yeah.
I think there are other applications that don't clearly have network effects. They don't clearly benefit from a growing user base, and so you just have to build premium features that are compelling enough for people to use them. That's an Evernote example.
Yeah.
And it's very hard to do. So I would say, if you're going to do that, you should assume that the growth in user base and engagement and your roadmap for premium features should be impressive enough that you're going to rely on investors for several years before revenue generation kicks in. And I think that's a very high burden of proof.
Yeah. No, I remember many discussions around, how do we split it up? Like, what do we give the people for free versus the paid? And it's something that I think happens a lot, and I don't think it gets discussed enough. So that's
well, and it's a more general. It's a very specific part of the pricing strategy.
Exactly.
And I think pricing strategy is something that people do in ways that are generally pretty random.
Yeah.
And it's a way that one can create and destroy a ton of value by doing really thoughtfully.
Yeah. Even just choosing price points. Well, those guys are doing it at $9.99 a month. I guess that's what we should do, right? And I mean, in some cases, people will charge a lot more, and they discover, people are paying for this, right? It's a premium product; they're willing to spend the money. So, I don't know. There's a little bit of voodoo in there sometimes. So, what I found that's really helpful is just having that experience and being able to draw upon that to say, okay, when we did it this way, that didn't work. When we did it this way, and you gave a great example there. There are probably 30 others we can come up with where you can see what's going on. I see this now, actually preparing for FounderLine, just in the online storage market with Box and Dropbox and Google Drive and all these others. And Google just dramatically lowered the pricing. Like I think it's about 10x lower than Dropbox. And so we were looking at going, well, why would we go do that if Google Drive is giving us the same thing for much less money? And those are the outliers, right? When you got a big gorilla who's maybe underpricing you or something.
Well, I think the case where you've got a cost, so a freemium model where you have a real cost of goods is very challenging.
Yes.
And if you add into that having a Google who can give more stuff away for free longer, then it's definitely a tougher situation.
Yeah, it's a great question from Ron. So hopefully, Ron, that helps out a little bit, and something that a lot of startups face. So let's turn now. We have a tweet that came in from Chris, and the tweet was, "I love having kick-ass advisors. Where do I find them? Should I use the ones my investor pushes?" So, generically, talk a little bit about advisors and how you find great advisors. You as an investor, maybe you recommend people into the company, or how does that work?
Yeah. Well, I think that the right advisors can make a huge difference, and especially ones who have a prescribed role that you're asking them to play. So I think the general notion of I'm a startup and therefore I collect advisors and I get to put them on my website, but I never call them and they never call me, totally useless.
Yeah.
Right?
Yeah.
And so on the other hand, there are people who I think can play an incredibly valuable role. And what I try to do is to introduce founders and CEOs to people that I think can be helpful, but then try not to push them.
Yeah.
And because there is an element of chemistry that matters there too. And that chemistry determines how easy it is for them to pick up the phone and call one another, whether or not the founder recognizes this is an area where expertise is valuable and he or she doesn't have as much of it yet. And I think if the people that I tend to rely on as advisors are people that I know and have worked with. So for a founder, I think the single most valuable ones are the ones that you already know and have worked with and trust. And I think if you like your investor and trust your investor, then I think the ones that they have worked with previously that they know and like and trust is a good thing. But I try to end up in places where we've got a relationship of trust that goes back and forth. And if you're in a different situation than that, frankly, that's a tough spot, and picking advisors isn't going to be the way that solves it.
What areas do you find that companies need the most help with advisors? Like are they product advisors? Are they pricing model advisors? Go-to-market strategy? What do you see in most of your businesses?
Well, so let me answer a slightly different question than the one that you asked, which is I think and I wrote about this in an article that was published this week about sort of CEO as chess master.
Oh.
The people that I end up really enjoying working with are often ones who know what they don't know. They actually can sense a gap in their own knowledge base. And so the most valuable advisors are ones where the CEO has a lack of knowledge or a lack of experience.
To plug that hole.
To plug that hole.
Yep.
And so it isn't, I don't think generically the case that product-oriented advisors are useful and sales-oriented ones are not. But it depends a little on the expertise and experience base of the founder. I will say that we work with a lot of product-oriented founders where therefore that initial go-to-market, that initial penetration strategy, the early sales is one of the places where they tend to need more help. But again, it depends on which founder you're talking about.
No, that's great. We had Paul Martino from Bullpen Capital here last week, and I had worked with Paul on my previous company, and I told him one of the best things about him was he told me when he didn't know the answer to something. We were talking about a marketing topic one day. He's like, Joe, I don't know anything about marketing. We should get you to talk to A, B, and C, and that was really helpful. And in the same way, having a founding team that knows where their weaknesses are and isn't shy about saying, well, that's where we need some help. I think those can be really productive relationships where they know their limitations, and that's where you can step in and help them, introduce them to other people or whatever it might be.
Yeah, that's right. I mean, I think the other place that those kinds of relationships can come from is from within an investor's portfolio. So we've been running this series of quarterly events on an individual topic where on high velocity business to business marketing, or building an inside sales team, or building and managing world-class engineering teams. And we've had sort of half from our portfolio and half friends of theirs that are interested in the domain, right? So we sort of bring that together, and the orientation has been less having a single expert speaking, but picking 4 of the people to do TEDx style 5-minute talks and get the engagement. And that's a way that you end up meeting people within a functional discipline and being able to tie together. And I think there are many other firms that are good at doing things like that. And I think that's probably one of the highest and best uses of the incubators and accelerators, is to have that group of peers.
Oh, that's great. And are those events open to the public, or is just for your portfolio companies and the peers who come to give the talks?
It's generally been the latter, but it's we have what we typically do is we invite our portfolio companies, we invite other people we know in the discipline, and we'll often ask the portfolio companies if there are other people that they think should be part of the event.
So semi-public, but not anyone can show up to Stanford Stadium and see the talk or whatever.
Well, in part because we're trying to make them intimate enough that it's in part a community building event as much as a topical event.
Great. Well, let's see. We've got another question here over email from Michael in Palo Alto. The question is, in light about the rumors about Box postponing their IPO, what is the process of IPOing, and why might someone delay their IPO? So I think this is not just about Box, but I think it's generically, you went through that process as an employee at Netscape, and then, I'm sure with a bunch of your portfolio companies over time. So maybe talk a little bit about that. I think a lot of people in the startup world don't get to experience that. I know how lucky I was to have gone through it twice and as an employee, and that was a tremendous experience. But maybe shed a little light on that and why they might decide to hold back a little bit.
Yeah. Well, so I think there are several stages in the build-up to doing that, and you're really engaged with that process when you've gotten all your financials and your Sarbanes-Oxley compliance down, and then you pick bankers, and then when you pick bankers, you're kind of T-minus 90 days from filing, and so at that point you're drafting a prospectus, and then once you file, the bankers are basically sounding out clients and large institutional investors, and then you get to about T-minus 2 or 3 weeks, and you go on the road. And the CEO and CFO most typically are basically doing 5 or 6 presentations a day for 10 days, all depending upon the scale of it, all over the country or all over the world. And that's
to potential investors.
Absolutely right. So they're talking to potential investors. Actually, there are now there's almost always a version of that roadshow presentation, the 15-minute roadshow presentation that's available online somewhere.
Right.
Which is, I think, a pretty interesting thing to see. But part of what's happened recently is that I'd say the technology stocks in the public markets have been re-rated, where for the prior year, what was fashionable, if you want to call it that, is growth at any price. Maximize growth, whether or not it's capital efficient growth, just grow as fast as you can, and you'll get paid an enormous premium valuation for growing as fast as you can, full stop.
Yep.
And that was reflected in the private markets too. I think part of what happened in Q1 is that the world came back to growth at a reasonable price, and meaning we want you to be capital efficient. We want to understand line of sight to profitability. We want to understand. We want metrics like customer acquisition costs over the lifetime value of a customer to really work, and we want to be able to see that in the financials.
Yeah.
And therefore, even if you need more capital, we know that you're growing in a way that's capital efficient. And so when that change happens, some people who look like spectacular IPO candidates 3-4 months ago look like ones that actually need to step on the brake and use a slightly different execution strategy to fit into the current financial markets.
Got it.
Now, I mean, to me, the thing that I hear a lot, and I always the hair stands up a little bit on the back of my neck, is I was a founder or I was an executive in a company. Things were in 1999, 2000, things were going great. We had filed for an IPO. We were just about to go public. Then the world fell apart and we went bankrupt. Right?
Yeah.
And so to me, I mean, obviously some of those companies were never really companies, right? They were projects. But it's also irresponsible management to be going that quickly off a cliff that you can't step on the brakes and, figure out the business model. And look, Box has a terrific management team and a good set of investors around it. And I think as a company, it'll continue to be a fine company. But my guess is they'll have to change their
mix a little bit.
Change the mix a little.
Yeah. No, it makes sense. Well, great. Well, we're gonna transition here in a minute. But once again, if you want to contact us, you have a question, you can call us 1-844-4FOUNDER, email help@founderline.com, or tweet to @founderline. I want to take a moment to talk about our sponsors. We couldn't do this show without the amazing support we get from our two amazing sponsors, Orrick and Ustream. And first, I want to start out talking about Ustream a little bit. We met Brad, who's the CEO there, a while back, and the whole team over there got behind us and said, we want to make FounderLine happen. we want to get you up on the web and make sure you have the best streaming technology available. And so it's been an amazing process with them. We got up and running very quickly. They're available to answer our questions. In fact, I was just had to reach out to them. We're going to be doing some remote shows from Europe over the summer, and they've been great about helping us think through some of those issues as well. So if you need some streaming technology, whether it's for your meetings or you're thinking about doing some sort of show or whatever it might be, Ustream is the company you should go talk to. We use them. We love working with them, and you'll have just as great of an experience as we've had. So thank you to the team over there at Ustream. If you need more information, you can go to their website. It's ustream.tv. I'd also like to thank the team over at Orrick. So Orrick is helping us out. They're our law firm, and Mitch Zuklie is someone who I've known for many years, and we've worked together in the past, and now again here. And you know, when you're thinking about doing a startup, a lot of times people think about their lawyer as just someone who does the incorporation and sort of the nitty-gritty legal things. But really, to our conversation earlier about having great advisors, your lawyer is one of your strongest advisors, or at least they should be. And so having somebody who's seen way more situations around financings or hirings or firings or mergers or whatever it might be, it's just invaluable. And having been through that with the team over at Orrick in multiple situations, just having a great advocate and someone who has that corporate knowledge is just really helpful as a startup entrepreneur. So they're just the best. If you want to get in touch with them, you can go to their website. It's orrick.com, and I'm sure they'll be able to help you out. So next we're going to go to a segment we like to call Ask the Lawyer. So speaking of Orrick, we're gonna switch over, and we actually have Mitch with us from Orrick. Mitch is the chairman and the CEO of Orrick. And Mitch, welcome to episode 3. How you doing? Mitch, are you there?
Thanks for the kind words.
Oh, there he is.
Yeah, can you hear me?
Yeah,
can you hear me, Joe?
You're good now. How you been?
Doing great. It's great to be back on. Great to speak with you. Great to speak with Greg as well.
Hey, Mitch. Nice to hear you again, I should say.
Yeah, you're in the studio. You're like this voice coming down from the heavens, just so you know. So it's actually pretty fun. So the idea of this segment is to cover a legal topic that's relevant to startups. And we've got both Mitch and Greg here to offer perspectives, legal perspective, investor perspective, as well as entrepreneur perspective. And the topic today is actually, it's a really important one. Many times in startup financing, the entrepreneurs focus on the amount of capital they're raising or the valuation, and they don't worry about some of the other more subtle but perhaps even more important aspects of the financing. And so the topic today is around participating preferred, or participation as it's called. And as I've seen in the past, the way this is structured can have a dramatic impact on the company's future exits, and it's sometimes a little bit confusing. So I thought we'd spend a few minutes walking through that. Maybe Mitch, you can walk us through kind of the high-level concept and how it works, and then we'll have a little discussion around it.
I'd be delighted to, Joe. So, one of the key terms that distinguishes preferred stock from common stock, and therefore justifies the price differential between the two, is liquidation preference. And liquidation preference is what enables the preferred stock to receive a payout prior to the preferred stock in the event of a liquidation event. And the simplest way to think of a liquidation event is an acquisition of the company, whether that's a high-value acquisition or a low-value acquisition. That's the type of thing that triggers liquidation. I think the best way to describe the way liquidation preference works is through a simple example, and then I'll layer on a couple different complications. So let's assume we have a company that has only issued 200 shares, 100 shares of preferred and 100 shares of common. And let's assume that they sold that preferred stock at $1 a share and sold the common stock at 10 cents a share. And let's further assume that that company was acquired for $300, not a Grand Slam home run. In a situation where there was no liquidation preference, assume there's no liquidation preference, so the funds would be distributed in a pro rata basis. The preferred, had 100 shares. The common had 100 shares. So they would split the proceeds equally, 150 going to the preferred and 150 going to the common. If we had a situation where there was, and I'm going to use a simple term, non-participating preferred, which means it's also described as a one-times liquidation preference, the preferred would get the first $100, the amount that they invested, in advance of the common. And then they would stay as preferred. So it would be $100 would go to the common. $100 would go to the preferred, and the remainder would go to the common stock, all 200, because they've met their 1x liquidation threshold. And as a practical matter, almost every time you have preferred stock, you can choose to convert your preferred stock to common. So in that instance, rather than keeping $100 out of $300 total, the preferred would choose to convert to common stock, and they would take 150, and the common would take 150.
Right, makes sense.
Another example is participating preferred. So with participating preferred, the preferred holders first get their investment back, and then they participate with the common on an as-converted basis in the remaining funds. So they not only have downside protection, but they also get upside protection. And they no longer need to calculate whether they convert to common stock or not, as they will be able to have their cake and eat it too. So in our example, $100 would go to the preferred first, and then they would take one half of the remaining $200, or $200 total, and the common would take one half of the $200 that remained after the $100 preference, or $100 total. And the amount of benefit to the participating preferred can be limited by putting in something called a cap, which provides that the most that the preferred can receive is some multiple, say 3x of their initial investment. And that basically reintroduces a concept at which the preferred would have the choice about whether to convert to preferred or stay, to convert to common or stay preferred. So a couple examples, one non-participating, a second fully participating, and then a participating preferred with a cap. So one real question is, why is there a rationale for having participating preferred at all? Obviously, it protects investors, and you'd also note that participating preferred matters most when it's a low or moderate exit. So if we sold that company for $1 billion as opposed to $300, the $100 of additional preference is really completely immaterial, and it wouldn't make much of a difference. And I think most often what we're seeing is that the participating preferred features are often helped used to bridge the gap if the investor and the entrepreneur have a difference in valuation. Maybe we'll come back to that in a second. The last thing I'd note is that it probably sounds at first blush like participating preferred is always an investor-friendly term. And in reality, in many instances, I'd say about half the time, investors don't want it. Now why is that? And the answer is, with a typical venture-backed company, the size of the financings will increase over time. And very often, the subsequent financings have terms that mirror those of the prior round. So if you had a $500,000 Series A, when it had participating preferred, it's quite likely that the $3 million Series B and the $30 million Series C and the $100 million Series D might have it as well. And the effect to the early round investor, the one who participated in the A round or the A round and the B round, of setting up this template may come back to hurt them, because if you look at the situation where the D round has, say, $100 million in it, and that $100 million goes back to that investor first, the interests of those early investors are probably a lot more aligned with the founders and common stockholders than they are with the latter stage investors. And as a result, many early stage investors, and again, I'd say about half of the time, choose not to put in participating preferred. I know that's a lot of information, and I'll pause and see if that all made sense to everybody.
No, it's great. So, I'd ask Greg, so, when you're doing a round, and are you guys are typically in the A rounds?
Yeah,
Is that where
most typically trying to lead a Series A financing that might be a $2, $3, $4 million investment from us.
So how do you look at the world in those cases? What do you try to accomplish on the participation side?
So I think Mitch's comments are exactly right. I mainly think it is not in the interest of the company or the Series A investors to have participating preferred at that time.
At the Series A.
Absolutely. And I think by the time, so he's absolutely right, by the time you stack on Series B and C and D, then if you do it in Series A, all that's going to be participating preferred, every single bit of it.
Yeah.
You almost never go back. And I think, this is true in general of I think early stage venture capital investors, that when you invest in a company, there is effectively no asset value, right? If the founding team and management team doesn't create value, there will be no value, right? And therefore, you care about whether the management team has the right incentives, has the right opportunity to benefit from the value of their creation, and so setting up a capital structure that's going to be participating preferred for the indefinite future, I think is a bad idea.
Yeah, no, and from the entrepreneur side, it's something you try to avoid. I mean, Mitch, I think in our past probably ended up at some sort of 1x participation at some point. Maybe not at Series A, but what about seed rounds, Mitch? You see a ton of seed rounds. Do you advise your clients to push back on that at that point and try and avoid any participation there?
Yeah, I think I do, and I would say that you probably see it, I'm going to guess 40% of the time in seed rounds, Joe. It's a minority, a sizable minority, but still a minority that you actually see it. And I would also say that there's been various flavors of what's customary. There was one point in time where 3x, 4x liquidation preference was the norm, probably 6 years ago, and it's really, I think we've really moved away from that as the norm in the last couple of years. We'll see. I think as long as capital remains flowing reasonably well, we'll probably see not as much demand for these liquidation preferences as were customary in the mid to late aught years.
Got it.
I remember being in a meeting of the Early Stage Venture Capital Association in the year 2000. Maybe it was 2001. And people were sort of going around talking about all of the egregious terms that they were getting because capital was no longer flowing freely, and therefore they could assert these terms. And I just remember saying, guys, I think you're looking at it all wrong. And it was mostly guys, sadly, it was then and still is, but you're looking at it all wrong, which is that if the company doesn't build value, nothing else matters. And therefore, founders having too much of this stuff overhanging them as they're out working 78 hours a week trying to build this company is the wrong idea.
Yeah, no, I can tell you when you're sitting there with a huge preference hanging over your head and you're really busting your butt to turn this into something and maybe the winds are blowing in your face at that point, you do kind of question, well, should I keep going with this or do we just pull the plug? And those are hard decisions, obviously, but those are cases where you really want to try and be aligned with your investors. Sometimes you can be, and sometimes you can't be, but avoiding that to the extent possible, I think, is really helpful. So, Mitch, we're gonna go on to some.
I would also say.
Oh, go ahead.
Sorry, one last point, Joe, and thanks for giving me the time. I would also say that, frankly, one of the more contentious issues, if a company stumbles somewhere along the way and does a recap, is what you do with that liquidation preference that exists from prior rounds. It's one of the areas where you see fights, and you find a new investor having very different incentives from prior investors. And as a result, if you don't have participating preferred and don't have meaningful preference stacked up in front of the common, it makes that negotiation much easier. So I'm a big fan of getting rid of liquidation preference if you can do it. It simplifies things. It prevents fights if there's ever a slip later on. And it prevents a situation, I think, where later stage investors have a very different set of priorities from the early stage. So with that, I'll let you guys get back to it. But it was great talking with you, Joe. Great to talk with you, Greg, and appreciate the chance to speak with your listeners, Joe.
Sounds good. Thanks so much, Mitch. We'll talk to you next week. So thanks to Mitch Zuklie for joining us. Once again, if you have a question, you can reach us by calling 1-844-4FOUNDER, email to help@founderline.com, or tweet to @FounderLine. So we've got some more questions coming in. The next one is from Larry in Yuba City. Larry is a repeat offender, some might say. So he's been watching regularly, and his question is around pricing, which we were talking a little bit about earlier. How do you recommend finding the right price? You don't want to price too high and lose people before you start, and you don't want to price too low and leave money on the table. Do you try several prices simultaneously, maybe do some A/B testing or something, to see which ones have traction, maybe through different entry points on your website? Do you try different prices sequentially? Do you price slightly higher than you think people will pay? And do limited time discounts, other strategies? So great question, and something, as we said earlier, comes up in every startup, right?
That's right, absolutely. And I think that there are, generally speaking, the answer to his question is yes, those are good things to try.
All of the above.
But I think the pricing exercise starts basically on the whiteboard, not on the website. And I think that notion of saying, it's a little different for consumer products and business-oriented products. But
his is, I'm pretty sure, is an enterprise product.
Okay, yeah. So, what you really want to do is you want to go do the ROI analysis with your customers. How valuable is your product? How much time are you saving them? How much money are you saving them? And some of that you can even do conceptually before you have produced product, as you're going out and talking to people about the implications of it. And I think you want to ask people what they would pay in these cases, and they'll usually tell you a lower number than they're willing to pay. But I think oftentimes when you go out and do that analysis, you can comfortably be in the 20, 30, rarely as high as 50, sort of 20, 30% of the value that you create for people over a period of time. And I think most companies start out with a lower price just because they want to get the first sales, right? You want to get customers, you want to get proof points, and then you have some ability to raise prices over time. It's hard, though, if you say, for example, we're going to be at 10% of the value, pretty hard to get to 40, right? Or you might get there over 7 years, right? You can do it kind of incrementally. I think when you're in market, yes, absolutely. You're thinking through, you're running A/B tests on your website, and you're splitting traffic and seeing what conversion rates are at different price points.
Great. Yeah, I'm pretty sure Larry's working on something in the medical field, and I know that there's a company, Practice Fusion. I don't know if you're familiar with them, but I'm pretty sure they started off doing something for free, right? It was, I think it was ad supported, and then adding some features on top of that over time, and apparently have grown quite dramatically. So, but I agree, Larry. You got to try a bunch of different things, see what's working for you. It's a little scary at first because you are in that dilemma of how do I make sure I don't screw this up, and in many cases you don't know. So I think you have to be flexible. Your early customers, you need to treat them really like gold, like take such great care of them, be responsive on the customer service side. And I've had customers tell me, we really love your product, but we're not willing to pay for it. And at that point, you got to move on and
that's right,
make a change.
I think the other thing, this may be repeating myself, but I always thought of product manager as the shadow CEO, right?
Yeah.
So whether you're a product manager or a CEO, it starts with customer, right? Customer segmentation, knowing who is your customer. I mean, I always ask in a meeting with an entrepreneur, who did you build the product for?
Yeah.
Right? And that has some implications for what kind of sales and customer acquisition you're doing, for price points, for how you end up building that whole integrated business system. And so if, for example, you have one of these products where you say, well, it might be a freemium product, but we think we should charge, but we want to get massive customers, then you're going to have to price low.
Yeah.
And you may have, you want to get and that's generally called penetration pricing, right? You want to just get as many customers as you can, but in the meantime, and you want to be able to harvest that base over time and the like. But in the meantime, you want to pay the bills, so you're not wholly dependent on investors.
Yep.
And then there's and then there are folks who say, Siebel Systems was built this way, and that would be the classic example. Tom Siebel would just say, look, if people aren't paying for it, they don't value it. We're great, and we're going to march in there, and we're going to tell them that it's $1,000 per user, and people are going to pay it. But we're selling to enterprise customers with enterprise sales reps driving around in BMWs, and this is just what it costs. It's a totally different strategy than Salesforce.com. The current world is more oriented towards Salesforce.com, but they both work. Right? I mean, Workday is basically Siebel Systems.
Is that right?
I mean,
they're on the high end.
Well, they basically, I'd say it this way: they, in doing a software as a service company starting in HR, they basically said, we're going to build for the enterprise market. It's going to cost real money, and we're going to sell it to them, and we're going to have to sell it to them. It isn't freemium. It isn't self-service. It isn't SMB. And, post-downdraft, it's a mere, $12 billion market cap or something. It is still very possible to build companies that way.
Well, and the HR, I mean, pretty critical function inside of the enterprise, right? So probably a wise choice to value that at a pretty high premium. All right, so we've got another email that's come in from Sam, and this question is, how do you deal with brilliant but difficult team members? I have an engineer on my team who is kind of a lone wolf and tends to alienate other members of the team, some of whom have expressed concern, and I'm at a crossroads where I need to decide whether to keep this engineer or let him go. So what do you think? It's a tough one.
This is a really hard one, and frankly, it's really hard in as a venture investor, as much as it is as a CEO or entrepreneur. And I think people are have radically different points of view. Honestly, I fall into the camp most of the time that says, life's too short. We can find 5 great entrepreneurs a year that we want to work with and that we're excited about working with and the like. There are some other people, my former partner at Sutter Hill, Mike Spicer, who I think, and Fred Wilson, who's at Union Square, who's a good friend, who basically say, hey, look, everyone can do the great to work with CEOs. You really make your career by figuring out how to work well with the difficult ones. And to me, I think this, as a CEO, you probably have fewer choices than you do as a venture investor in that regard.
Right.
And but I still think you either have to coach the person, you got to put bubble wrap around them so they don't mess up the rest of the culture, and let them do their things of sheer brilliance in isolated fashion, or they got to go. And most such people aren't all that open to coaching and organizational development and developing better communication skills over time. But when I was at the Netscape 23, one of the founding engineers came up to me, and he said, you were always. I was 30 and they were all 22, right? None of us were really very old, but he said, you were. You were always the calm one and communicated clearly, and I appreciate it, but I didn't know what it was. And now that I'm 20 years older, I realize you just talk like a guy who'd been through marital counseling.
That's great.
But it turns out that the human skills of being able to communicate with your peers and even disagree with them without pissing people off is a useful skill.
Yeah, and I've been through this exact situation with difficult engineers, and there is definitely an art to managing teams and people who are sometimes difficult and how it affects the others, and it can go one of two ways. People just get so fed up with it, and it's damaging the environments so much that you just have to say, look, we're gonna cut our losses here, and it's gonna cost us because that person was brilliant and they could write code twice as fast as anybody else, but the larger team is suffering, and it's creating a huge wake behind the boat that we can't deal with. The other thing I found is trying to work with them and actually turning it into. I remember with a recent company who shall remain nameless. Everybody has their pros and cons, and there's a special bond that forms when everybody on the team can recognize each other's strengths and weaknesses, and sometimes poke fun at the weaknesses, like, hey, John, that's you being a miserly curmudgeon again. So, when you're ready to come out of that phase, come back and talk to us. And they can take it in such a way that they realize, all right, maybe I'm being crazy right now, and the next day, everything is forgotten and people move on. But sometimes, you have to have those difficult conversations and say, look, this is not working out, and we're going to have to make a change.
Right.
And
some of it does depend on company culture and environment. So there are some companies, Return Path would be an example of the companies that I work with, where the company culture and the sense of how their investments in people and how people are treated and the like is so central. That person at Return Path is gone.
Yep.
And I would say there are other companies, and this is probably even more true the more complicated technology is involved down the infrastructure stack, that are so innovation focused that person, gets gilded and has, incredible power in the organization, but the organization really needs them.
Yeah.
And I think figuring out which kind of company you are, and which kind of company you want to be is as important as figuring out what to do with a specific person.
Yeah, those are tough. So good luck. I hope you guys figure it out. And we have time for one last question, and this one came in over Twitter. When is going into an incubator a terrible idea? And I guess I would add, or a good idea, right?
Yeah.
So lots of incubators out there, lots of opportunities for people to get help on their startups. What's your take? What have you seen with some of the companies you've worked with or seen before?
Well, I think the biggest thing to think about is that going into an incubator is a little bit like a financing round. You're going to give up 7% of your company if you go to Y Combinator, right? So the question is it worth it? And so I think my general point of view is that if you are in one of the major hubs and you're reasonably connected to the entrepreneurial community and the venture community around it in here or in Manhattan or in Boulder, Colorado or the like, it's probably, you probably don't need it. You probably have access to counsel and advice, and you can probably manage that through on your own. On the other hand, if you're disconnected from those environments, you're in a remote geography or you literally don't know, if you have an idea, you could pick up the phone and call me. You can call 20 other people, right? But if you're not in
I'd call you first.
Thank you. I appreciate that. I appreciate that. You always did recognize quality.
Yes.
But I think they can be pretty productive. And one of the things that I think is interesting is that there are incredibly talented people who are now being attracted into these incubators, who frankly, without incubators, they might be off doing something else. So that's actually, I think, a wonderful thing and productive for the nation and the economy.
Sounds good. Well, great. Greg has been a great guest with us today, and I'm sorry we're out of time. We have a bunch more questions. We'll try to get to some more next week. So thank you for joining us. You can follow Greg on Twitter at GSands, GSANDS. Or his firm at Costanoa VC. And I won't try to spell that. I'll probably screw it up. But tune in next week for another episode of FounderLine. Our guest will be Jeff Ralston from Y Combinator. One of the what a perfect segue that was, whoever asked that question. And also Imagine K-12. So Jeff's actually involved in two incubators, if I can use that term for them. I've known Jeff for a long time. He's a great entrepreneur. He's been at companies like HP and 411, which became Yahoo Mail, and spent a long time at Yahoo and then at La Media, which was purchased by Apple. And it'll be a great show. So next Thursday, 5 p.m. Pacific time here at FounderLine.com. Thank you once again to our amazing sponsors, Orrick and Ustream. We couldn't do this without you. You can follow us on Twitter. It's at FounderLine. Send us your questions. Even during the week, we'll try and get some more of those on. It's help@founderline.com. You can also go to our website and submit questions there or subscribe to email updates. We're actually hopefully tomorrow we'll be going live with the audio podcasts up at iTunes, and so you'll be able to download the podcasts and listen to those. So thanks for watching. Here's to the crazy ones, and we'll see you again next week.